I'm Michael Yardney, and the fact is most property investors fail. So today I'd like to share two things with you that most investors fail to do. First of all, they fail to have a formulated property strategy, and the second factor is that they actually don't review their property's performance. Looking at this, it should come as no surprise that most investors never get past owning one or two investment properties. If you don't really know why you want to build a property portfolio or how one day you're going to get out of that rat race, and if you don't really know where you're heading, how will you know which properties to buy? And how will you know if you're on the right track and on target? The trouble is, if you don't know where you're going, any road can get you there, but any road can also get you lost. And nowhere is this truer than in property investment. So what are your goals? How much money do you want your property portfolio to produce for you? How many properties are you going to need to achieve this? And what type of strategy are you going to follow? Is it going to be capital growth? Is it going to be cash flow? Or are you just going to leave it up to luck? Currently there are over 350,000 properties on the market in Australia, yet not all of them will make good investments. In fact, most won't. Probably less than 1% will. So to ensure I only buy properties that outperform the averages, I use my 5-stranded strategic approach. Firstly, I only buy properties that would appeal to a wide range of owner-occupiers. Not that I'm planning to sell my property, but because owner-occupiers are going to buy similar properties, pushing up values of local real estate. This will be particularly important in the current market, where the percentage of investors in the market is likely to be less than before. Number two, I'd only buy a property below its intrinsic value. And that's one of the reasons I avoid new and off-the-plan properties. They come with a premium price. The third factor is I look for an area that's had long, strong history of capital growth, but more importantly, that will continue to outperform the averages because of the demographics in the area. This is an area where there's going to be more owner-occupiers, where they're going to want to live because of the lifestyle choices, and one where locals are prepared to and can afford to pay a premium to live because they've got higher disposable incomes. In general, these are the more affluent inner and middle ring suburbs of our big capital cities. The fourth thing I look for is a property with a twist, something special, something unique, something different about it, something scarce. And finally, I only buy properties where I can manufacture some capital growth, maybe through refurbishments, renovations or redevelopment. Rather than waiting for the market to deliver me capital growth, I do the heavy lifting through my value add. While most investors read a book or two, do a little research, read the magazines, and then buy one of the first properties they come across, strategic investors are smarter than that. They follow a system that's rooted in the real world, one that stood the test of time in changing markets. By following my 5-stranded strategic approach, I minimise my risks and I maximise my upside. You see, each strand represents a way of making money from property, and combining all 5 of them is a powerful way of putting the odds in my favour. If one strand lets me down, I've got 3 or 4 others supporting my property's performance. But it doesn't end there. I also suggest you regularly review your property portfolio. While most investors just buy a property and hold on to it for the long term, strategic investors regularly review their investment portfolio's performance. When I ask investors how their properties are performing, they usually have no idea. They've just closed their eyes, crossed their fingers and hoped for the best. It makes no sense to invest in a property and then not review its performance every year or so. Some investors avoid the tough decisions and excuse their property's poor performance by saying things like, it's going to eventually turn around, or I don't want to make a loss, so I'll sell it when I can cover my costs. Now, here are some questions you should ask annually about your portfolio. Interestingly, every year I ask myself these questions about each of my investment properties. How has this property performed over the last few years? I ask, knowing what I know now, would I buy this particular property if it was on the market today? I'd ask, is this property likely to outperform the averages over the next decade? I'd also ask, is there anything I could do or should do to improve the property's performance to generate a better return for me? Look, logically, if a property hasn't performed well over a 3 or 4 year period, it's likely to be a dud investment. The answer to all these questions ensures I only retain top performing properties in my portfolio and that my money's working hard for me. But I bet some of you are thinking, isn't this the wrong time to sell? If you do your financial capacity, you can only hold, 5 properties. You should aim to own the best 5 investment properties you can. This means if your property isn't giving you the return you feel it should, then it might be the time to make a change, either through renovations, or maybe changing property managers, or maybe selling up and buying a better performing investment property. Now, I know that it's likely if one of your properties is underperforming, it's probably in one of those locations where the market's flat. It may not even get the optimal price today. But I also know it could be one of those regional areas or in an outer suburb or in a mining town. But I'm suggesting you don't wait till that market picks up, because the gap between your underperforming property and better performing properties is only going to widen as the market moves on. That of course means it's going to be harder and more expensive for you to buy the sort of property that you'd like to own. I guess essentially the sooner you can identify and offload an underperforming property, the better. Sure, you may crystallise a loss or have to pay some capital gains tax on the sale and then pay the stamp duty on the next purchase. I understand. This may also mean you're going to have to take 2 steps back to move 3 steps forward. But if you treat your property investments like a business, and that's what all strategic investors do, you'll recognise it's not how much money you make that matters, it's how hard your money works for you, how much you keep afterwards that counts. I suggest you treat your property investments like an employee. Now look, you've probably heard me say before that you should treat your property investments like a business. And if that's the case, your properties are your employees. Think about it. If your employees came to work late, they played on Twitter and Facebook all day, they went and had a long lunch, and when they came back they weren't in the mood to see your customers or your clients, what would you do? You'd probably give them a performance review, which is actually those questions I just suggested that you ask annually about each of your property, and then you'd probably have to retrench them. Sometimes you'd even have to pay a redundancy package to move them on, so you could employ harder working people in your business. It's really much the same with your properties. These are your employees. These are the employees in your real estate investment business, and they've got to work hard for you. They've got to work hard for you in the long term. If your properties aren't giving you wealth producing rates of return, you won't achieve the financial freedom you desire. I've heard too many investors say things like, oh look, I know this property isn't going well, but it's not costing me anything to hold it. The problem is they're not factoring in the lost opportunity cost. Sure, their property may be cash flow neutral, but what these investors conveniently forget is the $50,000, $100,000 capital gain they may have made if they owned a property in a better performing location. The lesson for this is that sometimes you have to take a financial hit, remember that redundancy package, to allow you to move forward. This may mean crystallising a loss or paying an agent's commission or even paying some capital gains tax, even though many of these investors don't have much tax to pay. I know it's sometimes hard to make these critical decisions, and that's why many investors are just too emotionally involved with their properties. They've got difficulty evaluating their performance objectively. That's why I recommend you have somebody help you review your property portfolio annually. Sure, there's lots of other mistakes you could make as a property investor, but if you adhere to the proven investment strategy that I mentioned a moment ago, and then regularly review your property portfolio's performance, you're likely to avoid the majority of blunders that other investors make. Now, if you'd like somebody to sit with you and review your portfolio, see how it's going and make a suggestion about how to move forward, or if you're a beginner and you want to get going in the property market, why not have a chat with the team at Metropole? We have no properties to sell, so our advice is unbiased, it's independent. So give us a call or contact us through our website at metropole.com.au, and we look forward to being part of your wealth creation journey. You'll have a free see how your current property portfolio is performing.